Good day, students. Welcome to lesson 74. In this lesson, I will be marking exercise 5C and exercise 5D. Okay, so we're going to start with 5C. So you know by now that when we do the cash flow statement, there are three sections that we do in the cash flow statement. The first one is the cash effects from operating activities. The second one, cash effects of investing activities. And the third one, cash effects of financing activities. All right. So we start with cash effects from operating activities. And you know that the first thing they need to calculate there is cash received from customers. Okay. How do we do that? We start with sales, the amount from the income statement. In this case, it's 848,650. Okay. Then we see, was there any discount in this exercise? No, there was no discount, so there's nothing there to deduct. There was bad debts of 8,420, which we're going to deduct. And then we're going to add trade and other receivables at the beginning of the year, which was 73280, and we deduct trade and other receivables at the end of the year, which was 52,500. Okay. Then we add other income. Remember what we add under other income, not profit on sale of assets. We don't add that. We add commission income, rent received, interest received. Okay, in this case, there was only one type of income, and it was commission income, which was 36,000. Okay, so we add that. We add that because it's an inflow of money. Okay, so then if we calculate those amounts that I've given to you, we get to an amount of 897,010, and that is the total for cash received from customers. Okay, so now we get to the second leg of the calculation under cash effects from operating activities, and that is to calculate the cash that was paid to suppliers and employees. Okay, remember we're going to calculate the total stock purchased first, and then after that we are going to do a correction on that amount to get to the cash that was paid for purchases, for the purchasing of stock. All right. Okay. So the first small calculation what we do is to work out what was the total purchases of stock. Okay. How do we do that? We take the cost of sales, which we get from the income statement. We add the closing stock, which we get from the balance sheet, and we deduct the opening stock, which we also get from the balance sheet. Okay. In this case, the cost of sales was 368,780. The closing stock that we're going to add to that was 119,680, and the amount that we're going to deduct for opening stock was 126,450. Okay, if we do that little small calculation, 368,780 plus 109 less the 126,450, we get to the amount for purchases, which was 362,010. Okay. And then we need to add trade and other payables at the beginning of the year, which was 171,870, and we get that amount from the balance sheet, and we deduct trade and other payables at the end of the year, which we also got from the balance sheet, is 142,160. Okay. Then we need to add the other expenses or other payments, we need to add water and electricity, which was 26,800. There was no stationery. Wages was 246,000. Okay, and there was no sundry expenses. So it's only water and electricity and wages and salaries that we're going to add under the other payments, and that gives us 272,800. Okay, important to remember the three types of expenses that we're not going to add here: depreciation, loss on sale of fixed assets, and interest paid, interest on borrowed money. Okay, so now we add up those amounts. We've calculated the purchases amount, which is 262. Sorry, not 262, 362,010. Okay, plus the 171,870 trade and other payables at the beginning of the year, and we deduct 142,160, and we add the other payments of 272,800. So if we add all those amounts up, we get to the amount of 664,520. And that is the cash paid to suppliers and employees. All right. Okay, so if we add the cash received from clients, which was 897,010, and we deduct cash paid to suppliers, because we deducted it was an outflow of cash, we deduct 664,520, we get an amount, the amount 232,490, which was the cash generated from operations. Okay. But then we are going to add the interest on long-term loan. We are going to add this year, or any interest on borrowed money. We add that. Remember, I said to you right in the beginning, we need to enter that the interest on borrowed money needs to be entered on the face of the cash flow statement, and that is why we enter it here. It was interest on long-term loan. We get that from the income statement, and that was 5,500. Because we paid the money, it was an outflow of cash. That is why we enter that in brackets. So we're going to deduct that. And then the other amount that we're going to deduct, remember I said we're going to deduct drawings here. So the drawings was 65,000, and I got that amount from the notes to the financial statements. In other words, the notes to the balance sheet. And if I add all those amounts that I've just given to you, the 232,490, less 5,500 for the interest on the long-term loan, less the 65,000 for drawings, I get the total for cash effect from operating of operating activities, and that gives me an amount of 161,990. Okay, so now we get to part 2 of the cash flow statement, which is cash effects of investing activities. All right. The first item there is the purchase of non-current assets. Where do we get that amount? We get that amount from the notes. I think it's under note number 2, fixed or tangible assets. And we get that under movements. You'll see additions at cost. The total there was 200,000. So that is the amount that we're going to add there under the purchase of non-current assets. That is what we paid for the non-current assets that we bought for the fixed assets. And we write that in brackets. We're going to deduct that because it was an outflow of cash. It's money that we paid for fixed assets that we bought. Okay. The second item there is proceeds from sale of non-current assets. In other words, we sold non-current assets, and that is the amount that we received for it. Remember, I said to you, we are going to work with the carrying value of the assets that we have sold, and we get that amount from the notes number 2. Just under that additions at cost, you'll see the disposals at carrying value, which was 108,810. Okay, so we take that amount, and if there was like a profit on sale of assets, we would have added the profit. And in this case, there's only a loss on sale of assets, and I get that from the income statement. There was only a loss on sale of assets of 15,800. Okay, so we are going to deduct that 15,800 from the 108,810, and then we get to that amount of, sorry, let me just get it. Then we get to that amount of 93,010. In other words, that is the amount that we receive for the fixed asset that we sold during the year. Okay. And then under that heading, under the cash effects of investing activities, you'll see we work with investments. Either we placed an investment or the investment matured, that we received the money back. So we look in the balance sheet under our non-current assets. If there was an item like this, it would be under financial assets. It would be like a a fixed deposit. You would see that under that financial assets, but there's no such item under the assets. So there was in this case, no investment that we placed or that matured. So that is why those two amounts are zero. Okay, so then we add the amounts under the cash effects of investing activities. There were only the two amounts, the purchase of the non-current assets and the proceeds from sale. So it's only those two amounts that we add. And it was the 200,000, which is in brackets because it was an outflow, and then plus the proceeds from sale of non-current assets, which was 93,010. If we add those two amounts, we get to a minus 106,990. In other words, that means it was an outflow of cash, like in total, under the investment activities of 106,990, and that is that amount. We enter that amount in brackets just to show it's like we're going to deduct that in the end. It's like an outflow of cash. And then we get to the third and the last part of the cash flow statement, which is cash effects of financing activities. The first amount the first thing or item that we look, or that we have a look there, is proceeds from long-term loan. Okay, how do we know what that is? Where do we find that? We get that in the balance sheet, and it would be under non-current liabilities. Okay, there was a long-term loan from Golden Bank, and if I look at that amount, I can see there at the beginning of the year it was 50,000, and now it's 60,000. So the loan increased with 10,000. So it means that we borrowed another 10,000 during the year. So that was an inflow of cash. So that is why that amount is just like that. It's not written in brackets because an inflow is written just like that. We're going to add that it was an inflow of cash. So that is where that 10,000 comes from. It comes from, if you look at the balance sheet, under the non-current liabilities. Okay, and then there was no payment of a long-term loan. It was just that loan that we increased the amount that we borrowed. Okay, so that is why that the amount under payment is zero. Okay, so now we've got all the three totals. We have the cash effects of operating activities, cash effects of investment activities, and cash effects of financing activities. Okay, all right, so we're going to add those up. The cash effects of operating activities is 161,990 minus 106,990. 990 plus 10,000. Okay, if you add those three amounts up, you get an amount of 65,000, which was the net change in cash and cash equivalents. And the last step that you know by now is to check whether our calculations were correct. Did we make the correct calculation or not? Okay, how do we do that? We check that. We're going to have a look to see what was cash and cash equivalents at the beginning of the year and what was it at the end of the year. Okay, if you look in the balance sheet, you will see the cash and cash equivalents. At the beginning of the year, it was 14,500. At the end of the year, it was 79,500. So it means that our cash and cash equivalents has increased during the course of the year. And if we deduct the end of the year or the beginning of the year from the end of the year, we get an amount of 65,000, and that is exactly the same as the amount that we have calculated from, in other words, the total of the cash effects of operating, investing, and financing activities. So we know the calculation is correct. Okay, so now I'm going to mark exercise 5D. You'll see there under the required A, B, number C is do a reconciliation of the profit with the cash generated by operations. I'm not going to do that because that is actually the second method, method 2, which is the indirect method to calculate the cash effects from operating activities. And I said to you in the previous lesson that I'm not going to do that. Okay, so I'm just going to delete that number C under required. Okay, so we're going to start again with cash receipts from customers. And as you know by now, the first item that we look at is sales, and that amount we get in the income statement. Okay, then we look in the income statement, did we have discount allowed and bad debts? You'll see in this exercise there was no discount allowed, so that amount is 0. The bad debts that we're going to deduct here is 16,300. Okay. Then we are going to add trade and other receivables at the beginning of the year, which is 101,297. And we're going to deduct trade and other receivables at the end of the year, which is 193,190. Okay. Then we need to add other income. Let me just see. The other income, there were two other items under income. Under other income, it was commission income of 58,000 and it was interest for 20,400. And you will find those two amounts in the income statement. Under other operating income was commission income, the 58,000 and the 20,400. You will find that under interest income, just under operating profit, you will see that amount of interest income, 20,400. Okay, remember what I said to you in the previous lessons is that interest income, interest received, will be added here under other income. It is just the interest paid or the interest on borrowed money that we won't add to the other expenses or other payments because the interest paid has to be enclosed or has to be written on the face of the cash flow statement. All right, but interest received does not need to be entered on the face of the cash flow statement. So that is the reason why we can add the interest received under this item, other income. Okay, and then if we add those amounts, the sales, deduct bad debts, add trade and other receivables at the beginning of the year, deduct trade and other receivables at the end of the year, add commission income and interest income, we get to an amount of 3,730,987. And that is the cash received from customers. Okay, so now we need to calculate the cash paid to suppliers and employees. All right. Okay, and you know by now that we are going to work with purchases. We're going to calculate the total purchases, which was cash purchases and credit purchases. And then we're going to do a correction on that by working with the trade and other payables at the beginning of the year and subtract them or add them at the beginning of the year and deduct them at the end of the year. All right, but we're first going to calculate the purchases. So we start with the cost of sales, which was 1,668,110. Okay, and we get that amount from the income statement. All right, then we add the closing stock of 65,180 and we deduct the opening stock of 108,253. Okay, if we do that small little calculation, we get to the purchases amount of 1625037. Okay, and then we are going to add trade and other payables at the beginning of the year, and we're going to deduct trade and other payables at the end of the year. The trade and other payables at the beginning of the year was 389,370. Okay, we're going to add that and we're going to deduct the trade and other payables at the end of the year, and that was 378,500. 378,500. Okay, and then the last item that we need to add here under cash paid to suppliers and employees. The last item is other payments or other expenses, and we're going to add, there was only wages and salaries of 580,100 and also sundry expenses of 960,800. And you'll see there on the clip that I've just wrote there, remember. I'm quite sure you understand or you know why I wrote there, remember. And that is to remember that to other income and to other payments or expenses, we're not going to add depreciation. We're not going to add interest on borrowed money, in other words, interest on loan, and we're not going to add profit or loss on sale of fixed assets. Okay, so if we add these amounts under cash paid to suppliers and employees, it was the purchases of 1,625,037 plus the trade and other payables at the beginning of the year, that was 389,370, less trade and other payables at the end of the year, which was 378,500. Plus, we add the other payments or other expenses, which was the two amounts of 580,100 plus 960,800. That gives us an amount of 1,540,900. So if we add those amounts up, we get to an amount of 3,176,807. And that is the total for cash paid to suppliers and employees. Okay, so now we're going to calculate the cash effects of investing activities. And that is, we start with the purchase of non-current assets. Where do we get that amount? We get that amount in the notes to the balance sheet. Remember, it's notes. In this case, it's note number 3. It is the note for fixed and tangible assets, the movement in fixed and tangible assets. Okay, so we get the amount that we the amount that we paid for fixed assets that we bought, we get that under additions at cost, which is 155,000. Okay, so that is where we got that amount from. The other one just under that is the proceeds from sale of non-current assets. In other words, what was the amount that we received for assets that we have sold? Okay, we also get that amount from the notes, just under that additions at cost. You get disposals at carrying value, which was 85,000. And remember, I said to you, if there was a loss on sale of assets, we're going to deduct it from that amount. If there was a profit on sale of assets, we will add it to that amount. The profit will be added to the carrying amount and the loss will be deducted from the carrying amount. Okay, so let's have a look in the income statement. Was there a profit or loss on sale of assets? There was no profit. There was just a loss on sale of vehicles, 10,000 rand. So, okay, we're going to deduct that from that 85,000, and that gives us 75,000. That is what we received for the fixed assets that we have sold. So that is where we get that 75,000 from. And it's not written in brackets because it's money that came into the business. Remember, it is fixed assets that we sold during the year. So that is why the 75,000 is not written in brackets, because it was an inflow of cash. Okay. Okay, so now the last item that we need to calculate for the cash flow statement is the cash effects of financing activities. And you know by now, we just look for that, for the movement in that, we look under the non-current liabilities in the balance sheet. Okay, so in this case, it was a long-term loan from CC Bank. Okay, so what was it at the beginning of the year? At the beginning of the year, it was 300,000, the loan. At the end of the year, it was 260,000, which means that we have paid back 40,000. We paid back 40,000 of that loan, of the long-term loan from CC Bank. So it is an amount of 40,000 that will be written in brackets. Why in brackets? Because it was an outflow of cash. That's why we're going to deduct that from in our calculation. An outflow is written in brackets, is going to be deducted, and an inflow is without brackets. Okay, so then we have that 40,000 under cash effects of financing activities. We have the 40,000 in brackets. All right, okay. So the last step that we need to do is just to add our cash effects of operating activities plus cash effects of investing activities and cash effects of financing activities. Right, so it's the 91,180 plus the 40,000 plus or less 40,000, because that 40,000 is in brackets. Okay, so plus 40,000 less 40,000 gives us 91,180. Okay, and that is, in other words, that is the net change in cash and cash equivalents. And the last step that we need to do is to check if our calculation was correct. How do we do that? We have a look to see what was the cash effects and cash equivalents at the beginning of the year. In this case, at the beginning of the year, it was 86,110, and at the end of the year, it was 177,290. Okay, and that is quite obvious that the cash has increased during the year from 87 to 177,290. Okay, if we deduct the 86,110 from the 177,290, we get an amount of 91,180, which was the amount that we have just calculated. So that shows us that our calculation was correct.